Hey everyone, Derek here with Stellar One, and welcome back to Escape Velocity, where we take on the business nightmares keeping you stuck and show you how to push through. Today we're diving into a problem that's creating tax nightmares and making your financials worthless. Revenue recognition mess. Here's what's happening. A customer sends you a $50,000 deposit for a 6-month project. You book it all as revenue immediately because, hey, cash is in the bank. Fast forward to tax time and now you owe taxes on money that you haven't actually earned yet. Or maybe it's the opposite. You're spreading revenue across months randomly, and now your financials are so distorted that nobody can tell if your business is actually healthy. This isn't just sloppy bookkeeping. It's creating tax surprises, misleading investors, and making it impossible to plan your future. So why does this keep happening? I see 3 main reasons. First, treating all money received as immediate revenue. You're recording deposits, prepayments, and subscription fees as revenue the moment cash hits your account, regardless of whether you've actually earned it by delivering the product or service. Second, no clear methodology for multi-phase projects and partial deliveries. When you bill a customer $50,000 for a 6-month project, you have no systematic way to recognize that revenue as you complete milestones. So you either dump it all into 1 month or spread it randomly. Third, multiple revenue streams with different recognition rules handled inconsistently. Your one-time product sales, monthly subscriptions, annual contracts, and project-based work all have different revenue recognition requirements, but you're treating them all the same way because nobody documented the rules. Here's what this is costing you. Massive tax surprises and penalties. You recognize revenue in the wrong period, overstated income, and paid taxes on money you haven't actually earned yet. Or maybe worse, you underpaid and now you're facing penalties and interest. Either way, you're writing checks that you shouldn't have to. Also, financial statements that lie about business performance. Your Q1 is going to look incredible because you booked a year's worth of subscription revenue up front. Then Q2 through Q4 look disastrous. Investors, lenders, and leadership get a completely distorted view of your actual business health. Nobody can trust your numbers. Also, you can't accurately forecast or plan because your historical data is garbage. When you're trying to predict next quarter based on past performance, but past performance numbers are fiction because revenue is recognized arbitrarily, you're basically building forecasts on quicksand. Here's how you fix this with 3 steps. Step 1. Establish clear revenue recognition policies for each revenue stream and document them. Create written rules. Product sales recognized on delivery. Subscriptions recognized monthly over the subscription period. Project-based work recognizes based on percentage of completion or defined milestones. Deposits and prepayments go to deferred revenue until you've earned them by delivering. Train everyone who touches invoicing on these roles so that they're applied consistently, not randomly based on who processed the transaction. Step 2. Use deferred revenue accounts properly and automate recognition schedules. When a customer pays you $12,000 for an annual subscription, that goes to deferred revenue. Then set up automated monthly journal entries to recognize $1,000 per month as actual revenue over that 12-month period. Modern accounting systems and ERP systems can automate this for you. You shouldn't be manually calculating and posting revenue recognition entries every month. The system should handle the schedule based on the contract terms you enter. Set it once and let it run. Step 3. Implement milestone-based recognition for projects and track percentage of completion. For multi-month projects, break them into clear deliverables with revenue allocated to each milestone. As you complete phases, recognize the corresponding revenue. If you're doing a $100,000 implementation with 4 phases, recognize $25,000 as each phase is delivered and accept it, not all $100,000 when you sign the contract and send the first invoice. This requires project tracking that ties back to your financials. Another reason that integrated ERP systems matter. Your project management, billing, and accounting need to be speaking the same language about what's been delivered and what's been earned. Here's what changes when you fix revenue recognition. No more tax surprises. You're recognizing revenue when you actually earn it, so your tax liability matches reality. No more overpaying because you booked everything too early. No more penalties because you forgot to recognize something. Also, your financials become trustworthy. Investors and lenders can see real business performance, not accounting fiction. Q1 doesn't look artificially amazing, while Q3 looks like a disaster. The trend lines show what's actually happening. And you can finally forecast with confidence. When your historical data reflects reality, you can use it to predict the future. You're making plans based on solid ground, not guesswork. Look, revenue recognition sounds technical. It can be, but getting it wrong has real consequences: tax penalties, bad decisions, and financials that nobody trusts. The old way of recognizing revenue whenever it felt right, that doesn't work when you have multiple revenue streams, subscriptions for complex projects. And it definitely doesn't work when the IRS or investors start asking questions. Document your policies this week. Set up those deferred revenue accounts. Automate your recognition schedules. Do this and your financials will finally tell the truth. I'm Derek with Stellar One. If you're ready to break free from revenue recognition nightmares or any of the other problems strangling your growth, visit us at stellar1.io. Looking forward to seeing you in the next episode.